Good morning, everybody. How are we all doing? Morning, Oyster Check. Morning, Road. Morning, Comfortably Crumbs. Good name. Morning, Paul. How are we all doing? It's Friday, finally. Friday, like Fridays. I've been to the gym this morning, so hence I'm in my gym gear. All sweaty and horrible. But anyway. Right. So basically today we're going to go and have a look at what's coming up on the news, as usual stuff. Have a look at what happened yesterday with... news. Wasn't a lot of unscheduled news, but quite a lot of scheduled news. Have a look at the indices, see how we get on with the ORBs this morning. Usual stuff, really. Morning, Virginia. Morning, Rajiv. Morning, FTNet. So just quickly before we start on the news side of things, had a down day yesterday. First down day I've had for 7 days, I think, yesterday. Literally missed a huge profitable day by about 3 points. So yesterday's DAX was a double stop out. Basically, we went into rotation for the whole morning, basically until New York opened. So there's your open there. We basically tried to go to short, failed, tried to go long, failed, and we sat around all day basically until the news hit. So double stop out on that one yesterday. Very much the same on the FTSE. Broke long out of the ORB. So that's your opening range. Sorry, that was the one that I took there. Stopped out to the pip. Came back up, would have stopped out anyway. So nothing happened there. The Dow was a small profit. Basically, that was the opening range. Pushed up. I stopped out on a trailer. Would have stopped out if the trailer hadn't kicked in, which is good. But there was no real opportunity to make money there either. S&P, very much the same. Stopped out to the upside on that. Yeah, so the market took ages to get going yesterday. But the one that really killed me yesterday was this one, which was awful. So that's the opening range yesterday. Here, yeah. So that was the ORB. That was a 5-minute opening range. 10-minute was an inside bar. 15-minute broke the high. Pushed up above the high, pulled back into propulsion. That was my stop loss, yeah. So basically it pushed up just far enough to kick the trailer in. So the trailer kicked in pretty much at break even because it started exactly when that kicked in. Came down, stopped me out. Straight up. So basically my target, the propulsion gap's gone now, but the target was here, I think, TP1. And then obviously that would have been a runner. So that $3,000 loss that I took yesterday, I blame it all on the NASDAQ and basically that stop out, which literally was 4 points. So that's the difference between making money and losing money. If I'd have put my trailer at 30% of ADR instead of 20% of ADR, which is what I had it set at, that would not have triggered that trail. That would not have triggered that break even. And that would have triggered probably about a 4.5K trade, which would have left me 1.5K up for the day. As it happens, the difference between using that as a trailer and that as a trailer is $1.5 loss. $3,000 loss, sorry. So that's the difference when you're doing this back testing and you're doing system parameter permutation. The difference between one input can either make your P&L go up or down. It's that fine. So, but they all work. There's an edge in everything. So just not yesterday. So we'll see how we get on today. See if we can get that back. So 5-minute ORBs are in. Too small on the DAX. No trade on the FTSE because of the gap. Basically, the EA detects gaps. So if your candle closes right at the low, like it has here, and the next candle gaps, or the spread is too far that it is outside the range and you can't get a trade on, it will not take a trade for you. So no trade there this morning. Basically, safety features kicked in. So we'll see where we go on the 10-minute range. That will be a 10-minute range. We are within parameters there. So your broker may have not put a gap in there, in which case you will be on that. And if you're on that, you're short, obviously. So we'll see where we go. It's breaking down quite nicely now. So plenty of downside on these. So news-wise yesterday, we had quite a lot of news. Australian unemployment went up, which is negative for Australian dollar. The unemployment change was 2K, forecast in 21. So again, all negative for the Aussie yesterday. So if you have a look at what we got on the Australian pairs yesterday, obviously very big downward movement on that news and a continuation going on at the moment. So bad news for the Australians all across the board. Some of these have already recovered, but not necessarily because the Australian dollar's recovered. It's more because the other currencies pushed back. So that was your Aussie news. So obviously medium term, probably bearish Australian dollar for the moment. Pound news was irrelevant, really. US, very bullish news from the US yesterday. So the retail sales were up above forecast. Month-on-month core and normal. The unemployment claims, they came out pretty much as forecast. So it's 228 with a 233 forecast. We got a 221. So in the grand scheme of things, the deviation there is very small. It is positive, but ever so slightly positive. Not massively bullish, but it is all bullish. So as you can see, we've got a mix of bearish news, bullish, bearish, bullish. It's all over the place with the dollar at the moment. But we had that massive spike on the dollar pairs where Trump basically said he was going to sack Powell, and then he decided not to sack Powell and denied it. So we had that huge whipsaw thing that went on. But at the end of the day, the Fed cannot drop interest rates while inflation is going up. It is not forecast because of Trump's tariffs to do anything but go up. So the Fed is under massive pressure from Trump to drop interest rates at the end of July. But the data says they can't do it. So it's going to be really interesting to see what happens with the FOMC meeting in a couple of weeks' time. That rate, whether or not that actually does come down, it's going to be a real battle. The inflation figures are pointing that way, as you can see. Month on month, we got a negative with the PPI, which feeds into inflation figures. So it's possible that they could come down. But your CPI for the dollar went up and monthly sort of down as well. So it's looking like short term, we're not going to get any weakness or strength in that dollar. It's just going to stay sort of neutral. So it'd be interesting to see what Trump does about that because he's been throwing threats left, right, and centre. Right, so 10-minute range is in on the FTSE, so I'll be taking the break of that 10. That is close to 40% of ADR there, so it's probably about 35%. So it's done quite a lot of range already in that 10 minutes. So we might find that we kind of run out of steam a little bit on the FTSE. We'll see where we go. Range on the DAX was an inside bar, so no break of the 5 or 10. So we'll be looking to take a break of that 15, which it has now obliged. So there we go. So the 15-minute range is going to come in at, it's still light actually, it's for 40 pips or 40 points. We need 43. So that 15-minute candle comes down a little bit more. We need it somewhere around about this low, which I think it's just done. There you go, 43.97. So be taking a break of the 15-minute range on the DAX. Right, we'll come back to that in a minute. So that's your news basically from yesterday. We had a lot of Weller talking yesterday. Nothing exciting come out of him. Waller rather, not Weller. So so that's basically all the Fed talk from yesterday. Nothing really groundbreaking or new came out of that. Trump is to set US retirement market to open market to crypto investments. So basically, if you're in the US now, you can put 401k, you can put into gold and into crypto now as well. That's going to be fun, isn't it? And 93% tariffs on China batteries, apparently. So that's all we had out of yesterday's news, and nothing particularly groundbreaking. All we got this afternoon is Michigan. So market opens at 2:30. I'll be on obviously at 2:30 to trade that. We got Michigan at 3 o'clock. This is an absolute wild card, the Michigan numbers. Sometimes the market uses it and really dumps a load of orders in. We get big moves out of that. Sometimes it does absolutely nothing at all. So real lottery. Friday afternoon, Michigan numbers will do whatever it wants to. So just be aware of that. If you're trading the opening range breakout strategy, potentially half an hour after market open, you've got large volatility coming in. Right. So broken short on the DAX. Oh, Christ, that's a big range now. Okay, still within range. So let's just have a quick look at where we're potentially going. So obviously yesterday we had another up day. So we had 2 up days in a row, basically, Wednesday, Thursday. So the market potentially looks like it's wanting to push back up into these highs, but obviously potentially going to pull back before it does that. So, market structure tends to not go in a straight line. So there is potential for a nice breakdown today. These areas are of interest today. Lots of propulsion gaps to come in and retest to the downside. So there is an awful lot of liquidity to the downside that they can come and take advantage of. FTSE, not so much. We've got the range high from Monday there. No, sorry, Tuesday. We've got this lovely area of support coming up down here as well. So this kind of V-shaped recovery that we had on Wednesday, they did retest that propulsion and hold. So if we are going to break down from here, you want to be watching this area as well as your initial sort of bounce point. Failing that, we should get a bounce out of the 2-day low. But we'll see. We got to break down first, and it's not doing that. So my target to the downside on the FTSE is there, which is beautiful because obviously if we just push down and we bounce out of here, I'll be getting out down there somewhere. If we push to the upside, that's your high of the week. So upside target looks good as well. So FTSE looks nice and easy today. Assuming it goes somewhere, obviously. Struggling a little bit. I'm not surprised. It's already sold off a lot. So, right. So FX-wise, there's really nothing much to look at today. It's really dead. We've got this RSI dash, which is just completely flat at the moment. Literally everything is sitting between 45 to sort of 65. Everything is middle ground at the moment, as you can see. So the market is reset at the minute. We've either had a very strong push and we've pulled back, or we are just going sideways. So the market is in a little bit of sort of a sideways motion at the moment. ADRs, dead, nothing to look at. We've got quite a lot of weeklies, but they've all really played out. So yesterday we had a nice weekly reversal on the Aussie dollar. CAD, Aussie dollar, New Zealand, we had a nice weekly reversal on Wednesday. So you kind of your midweek reversal, if you like. The Euro CAD also was extended. Where's that gone? Up there. So that one was yesterday, but you would have taken it. That was the actual extension on kind of Wednesday, but it was a bit of a gap down. So anywhere down there, you bought it. Worked out beautifully for you. Euro New Zealand as well. That was your high reversal. That was good. You've got New Zealand dollar CAD. That was also another decent one. There we go. From yesterday. So beautiful weekly hit. Yeah, bounced straight out of it. Really strong move. New Zealand dollar yen, the same. We had the bounce yesterday on that one. And New Zealand dollar, US dollar. And US dollar Swiss as well. So New Zealand dollar, US dollar, that was your reversal. I've got a couple of trades on here that I've been trading stop loss on this account. Anti-sentiment trades. So I've been testing this website for some colleagues, basically, that I've been helping them develop. And part of that is a sentiment system. So I've been trading their sentiment system just with very small risk, just to see how it goes. There was a stop out there on that one. I think there's a couple of other trades I've got on at the moment on it. So yeah, euro pound, euro New Zealand, and pound Swiss. So these are anti-sentiment trades that I'm trading at the moment. But yeah, so there's your ADRs, or rather AWRs. If you look at the monthly ranges, the main mover is obviously the Aussie New Zealand, because they didn't change their interest rates, which I'm in. So very close to break even on that one today. So hopefully today we can get a little more downside momentum on that Australian dollar off the back of that negative news that we've had, and come back down into this propulsion gap. This is the area I think we've got a good chance of reaching, this propulsion gap. But it's going to need no more news on the Aussie or New Zealand. So the unemployment rate really helping out with that. Hopefully we get another couple of days of retracement on that. As you can see, we've got the CPI coming up on basically Sunday night, Monday morning. So if that number on the New Zealand dollar is bullish, which is actually the forecast is for inflation to come down. So if it does achieve that 0.6, or in fact, if it was to get something lower than that, potentially we could see some weakness in the New Zealand dollar. So I'm kind of hoping we get an upward tick on CPI for New Zealand. But other than that, we haven't got any other real news for the Australasian pairs. So just kind of hoping this momentum just carries the Australian dollar at the moment. So morning, Peter. Morning, Elevated. So if you've got any pairs you want to look at, let me know. There's not really an awful lot to look at. Oil, I'm still in. It's going the right direction. I added a little bit into it around here on Tuesday after the drop. It's just holding these lows, holding these ranges again. We have put in a double bottom. So this is the area I said to watch out for. We have double bottomed that. So the market structure basically is still long. We have broken to the downside, and potentially this could be a bounce point to come back down and test these lows again. But what I'm hoping is this is kind of extended market structure that is going to push up into this area here. So we'll see what happens. There's no forecast news from OPEC or anything at the moment. So we'll wait and see. But I just want to get out of this, really, this oil trade. So if we can come back up and hit that, I will take the vast majority of this off. I might leave a few bits and pieces on, but I just want out of it. It didn't work. The whole premise of this trade was the Iran conflict and a continuation of oil price spiking off conflict. And they basically decided, actually, yeah, you're a bit stronger than us, we won't bother. So that fizzled out in a week. So obviously what I'm looking at now is just a continuation of the grinding oil price to the upside, just to try and get out of it. So if we can get a 125 ADR off of that today, I'll be done. But we'll see. Right. Anybody got any pairs they want to look at? Did you manage to close Swiss yen? Yeah, out of Swiss yen. So I got out of that on Wednesday. So closed all that out, all aggressive drawdown control positions, basically, up here. This is a really tricky one. This is a little bit lucky on my part. The only way to deal with this type of situation, you don't get it very often, where you break out into all-time highs. This is a bit of an anomaly, the Swiss yen, but there's not a lot you can do with something that breaks into all-time highs or all-time lows, because you've got no support resistance to activate aggressive drawdown control at. So the only thing I'm going on with this is obviously look at the size of the RSI extension on a daily time frame. Yeah, when we got up to there. So, you know, we're going back 8 years, decade here. We've only had 2 instances ever where we've got to that type of level. Yeah, here and here. That was an intervention. That's where we are, where we were. So that's my aggressiveness. You know, we've had the biggest, strongest squeeze we've had for quite some time. into an area where we have not been at an all-time high. This thing has to give at some point. The market can't continuously push out of that level. So you can see where I was getting in with my aggressive drawdown control positions. Then we got divergence. So I basically just scaled in hard with aggressive drawdown control here and got out the whole thing. So the whole purpose of aggressive drawdown control is to obviously exit the position at a break even, not take profit. The trade is wrong. You are wrong. Your goal is not to make a load of money. Your goal is to exit and not make a loss. So I actually came out of it ever so slightly up. 2% I made on it. But as you can see, I did a double scale out. I was lucky. It's, half of trading is luck. I don't care what anybody says. If you're in a trade and news comes out, the market will be driven in a direction. You have no control over that. It's lucky. Yeah. So we had this big, strong push to the downside. They piled out the Swiss franc, and then it continued to the downside. So I closed out, as you can see, 90% of the position here at a break even. And then I got a 4-hour continuation push, basically. It's another hour for me. So that hour later, I was watching it like a hawk. And as long as it was bearish, I was sticking it. If that thing had gone bullish again, I would have closed out a bit more loss. But it didn't. It just came down and it gave me an opportunity to get out. I could have got about 5% out. But, that's not the purpose of this. The purpose of this is to exit. So all of these aggressive drawdown control positions, these are wrong. It looks like there's tons of trades on. Basically, because I'm kind of slightly manual trading at the moment, normally these would be one trade with a large lot. What I did was I kept spamming the button, basically, to build up one position out of multiple positions. So it's just scaling in multiple positions, basically. So yeah, out. But a bit lucky on it, to be honest. It's one of those trades where I just look at it now and, what I said after I got into it, I was like, what am I doing trading the Swiss yen? I'm trading a safe haven against a safe haven. I mean, it's because of the swap. That's the reason I trade it, because the swaps are so cheap. But look at that swap short. That suddenly dropped to minus 360. That was about 12. So, yeah, it's just a silly thing to trade. It really is. But anyway, we make silly mistakes sometimes. Road, yes, he's got out on Wednesday. Yeah. So yeah, out of that one. Aussie, New Zealand, I'm still in, obviously. That's coming down quite nicely. CAD Swiss, I've just taken that this morning. This is another anti-sentiment trade, basically. Euro CAD, I've been in that for a while. As a short, again, it's one of those just stuck type situations. I've banked once on it. I'm just kind of holding it, looking for, you can see I've got my TPs in place just to kind of get out of a majority of this when we get down into propulsion, just in case we bounce here on a pullback. There's no reason why the euro should be strong or weak at the moment. CAD is mixed as well. So the sentiment on both of these is kind of fairly neutral. So I'm just kind of, again, looking to get out of as much of it as I can. I'll probably, if we get down here and we double bottom on yesterday's low and Wednesday's low, I'll probably take a portion of this off. So, anything that is in green, basically, at the end of the day, I will probably just shut it out just in case anything happens over the weekend and do a little bit of drawdown control. Everything else that I've got running at the moment is sentiment trades. So oil is the only other thing. So I'm just waiting for that to get out of. It's a real tough time at the moment. Position trading wise, the markets are all over the place. It's the same as last time. This is what happens in a Trump administration. That's obviously conflict, but this is I remember from last Trump. It's very difficult. Position trading. It's not difficult. It's exactly the same. It's very easy, but it's very difficult to make money quickly because of the erraticness of the market. The market is not being driven by fundamentals in the normal way. So you end up getting into trades and you're thinking, why on earth is that doing that? That's totally illogical. There's nothing you can do about it, but Trump will cause weird movements. So you kind of have to just play along and stay in things longer and kind of adapt and bend yourself around what's going on. You know, one day you're saying, right, excellent, let's buy the dollar. The next day you're saying, don't be stupid, he's just announced X, and you want to sell it. It's impossible to take directional bias on anything. Indicators mean nothing in an environment where somebody has the power to reverse it like this. Yeah, I mean, you look at this RSI extension here. Yeah. You would have shorted it. You had another short opportunity there. But that has got nothing to do with the standard price action RSI strength movement. That is Trump. So, you know, you make a load of money, but you don't make it because of you're a good trader, because of your indicators working, your strategy working out as normal. You make it because someone opens their gob. And equally, you get into something, you look historically and go, there's an 80% chance this is going to work because it always has in the past. And then he'll open his gob in the other way. And you're like, why on earth are we driving up here for 3 weeks? It's nothing to do with technicals. It's nothing to do with fundamentals. It's just what he does. So it's a great strategy position trading for this type of market because the squeezes don't tend to come for long periods of time. Swiss yen's a bit of an anomaly. But they don't tend to come for a long time because things change too quickly. But also, you can't get out of things very quickly because the market spends a lot of the time going sideways. So to get an ADR's worth of movement in one direction, it actually takes a hell of a lot longer than normal as well. So it's just, you know, you're safe as long as you don't over leverage, which is why I'm trading a limited number of pairs at the moment. But equally, you know, it's difficult. The normal 5 to 15% a month, you know, I'm doing it, but it's like pulling teeth at the minute. It really is. So, you know, short-term timeframes working really well. But again, half of it's luck at the moment on short-term timeframes. You get these big, strong moves, but you also get a lot of sideways at the moment. All markets are the same. It's just a different market. You have to just adapt a little bit. Our Swiss yen are going out from short list of pairs that you will trade. Yeah, I think at the moment. I think I'm just going to leave all yen alone at the minute. I mean, there's no the yen hasn't got any power at the moment. Since the intervention, they have lost their, it's not an edge really, but I mean, it's always been a carry trade, the yen, where the market has always bought against the yen. The yen has always been weak. It's always had negative interest rates. So, you know, when you come out of 2 decades of an economic kind of process, which is running on negative interest rates, and you suddenly shift that into a new way of working, i.e. using interest rates to control inflation and not overseas bond purchases, the whole ecosystem of the Japanese yen changes. It's going to move in a different way. It's going to trade in a different way. It's exactly the same as that happened with the Swiss franc, yeah? So when the Swiss franc decided to remove the peg, the Swiss franc suddenly behaved very differently. So there's your peg removal of the Swiss franc, yeah? The Swiss franc had always been quite erratic and very moving around an awful lot because of its peg. They removed the peg, and it completely changed. The way that it traded completely changed. This is what we're seeing with the yen now. So it's difficult to know what to do with the Japanese yen because we should really be treating it like any other currency now, in the fact that it is controlled by inflation and interest rates and other fundamental news. However, we don't get much news out of the yen. And the market is used to just carrying it and making money out of it. So the costs of trading it in that direction are prohibitive. So the only thing you could really want to do with the yen pairs is try to buy them, which is the carry trade. This is why it's called a carry trade, because you get paid to long against the yen. You always have done for 20 odd years. So I just think the market's it's finding it hard to not buy it because it's too expensive to short the thing. But I'm not the type of person that can have a bias on something because there's no real reason to keep buying against the yen now. They're using interest rates. So if they're inflated, like we had the news this morning, we had their inflation numbers out this morning, and their inflation basically 3.3 on a forecast 3.3. So it's neutral. It's ever so slightly down year on year for the core. So if that is down, it means they would normally drop interest rates, but they've hardly got any interest rates to drop. So it's not going to behave in the same way as a normal instrument. So I'm not sure I want to get involved in any yen pairs at the moment. Just because I think the only thing really you will want to do is buy it. But I'm not into trend trading. I'm into mean reversion trading. So if we got a lovely big pullback to the downside on a yen pair, I would consider that, I think. But I'm not sure you're going to get one because the market is not, it's just not strong enough to do it at the moment. So I think it's just off the table. There's, you got an extension there but that was on that spike. That's on a Trump move. It wasn't on a fundamental or a technical. It was just a Trump. Yeah, I don't know. I think I'm just going to leave them all for the minute. I might take some sentiment trades on them potentially when I've got this. I keep saying I seem to have got very involved in the programming side of it. But when they've got this new website up and running, I might start doing some more different types of trading, sort of some more sentiment-based trading. And if there is a really good reason for a yen sentiment trade, then I might get involved in it with that, but with stop losses. I don't want to position trade it. It's a squeezy thing. It always has been a squeezy instrument. But, since that intervention, you can see, since the intervention, we've become very normal. In the past, we were that. Yeah. So since COVID, it's just gone back into carry trade mode until the intervention, obviously. So don't know what I want to do with it, really. If in doubt, stay out. It's my rule I've always played by. Morning, new beginner here. What trading platform are you using? MT4. MetaTrader. Welcome aboard. No quick money, but still I think it's a long-term game, especially if you have a day job. What's that mean? Just trying to reread it and think, huh? Are you replying to the new person? Yeah. We don't make quick money. No. If you've come looking for someone that's going to promise you to turn $100 into $400 in 2 days, this isn't it. There's plenty of YouTube videos out there that will teach you how to do that. You'll realize you can't do that, and then you'll come back here in about 4 years and go, I get it now. It's the way most people go. Everybody, I did it. Everybody gets the same. Unfortunately, now you're joining trading. If you'd have started trading in, I don't know, 10 years ago, yeah, you would have seen a handful of experts teaching you how the market moves. What you've got now, unfortunately, is a billion gurus on YouTube trying to make money out of YouTube subscriptions and selling crap, who are regurgitating things that have got so regurgitated they are now just watered down into nonsense. So 99% of everything you see on YouTube is going to be crap. Yeah. Anybody that mentions the word smart money to you, run a mile. Yeah. It's all based on a con man who basically made a fortune selling courses, basically regurgitating someone else's stuff that used to work. So he manipulated it into something new. Everyone went, oh my God, that's amazing. I didn't realize you invented the algorithm that controls the entire market. And they sucked it up for some reason. And the world now thinks that smart money is the way to go. This is a 50-50 opportunity. Yeah, it can do one of two things. Yeah, think of blackjack in a casino. This will either go up or it will go down. You have no control over whether it goes up or down. You have no control over when it goes up and down. The only thing you can control is risk. Yeah. So forget looking for a system or a strategy that's going to make you money. Start focusing on why the market moves. Learn why it moves, and that will help you. Watch my stuff, basically, because my stuff's no BS, basically. Everything. This is why there's 43 people in here, yeah? Because no one wants to know what I show them, because everyone wants to make £1 million. That's not how it works. If that was the case, we'd all be millionaires, wouldn't we? Yeah? None of the traders that you see on YouTube are millionaires. If they are a millionaire, it's because they've got a massive following and their Lamborghini has been rented to take photographs, and they make about 20 grand a month out of YouTube revenue. Yeah, they're not making it doing this. They'll tell you they're making it doing this, but they're not. Anyway, there we go. Short lesson in Welcome to Trading. The SHM, are you running it on VPS, on Robo Forex? And what was the starting account? The SHM. What's the SHM? I don't know what an SHM is. My VPS is not running at the moment. It's sitting here, not plugged in, because I've moved into a new house and realised that I haven't got a wired connection in my office. I've only got Wi-Fi, and my VPS hasn't got Wi-Fi. So I need to plug that in downstairs into the router at some point, but I haven't got around to it yet. ORB. I'm not. No, this is just my local terminal, and this is just running on Global Prime. I don't trade on Robo Forex. I trade on Global Prime because they've got the FTSE. Robo Forex haven't got the FTSE, but you can trade on Robo Forex. Doesn't matter. You just won't be able to trade the FTSE. What are my current settings for the initial stop loss and trailing stop? So it varies per instrument. So I'm using 0.15 as range at the moment instead of 0.2. Stop loss is where's my inputs? 15. So I always keep my stop loss to whatever my minimum range is. That way you are always going to have your stop loss either at the range or inside the range. Yeah. And my trailing stop is 0.3. I think it's 0.3 on most of them. Yeah, 0.3. Yesterday I had on the NAS, I had it set to point. Yeah, so the US indices I got set to 0.2 on the Dow. The NAS was 0.2 yesterday as well, and the S&P also 0.2. So slightly more aggressive trailer on most of the NAS pairs. But I usually keep these two with separate trailers on. Reason being is they move, as you can see, in sync most of the time. So I have two variations of the strategy running. Yeah, so this has got a tight trailer, this has got a loose trailer, or rather the other way around now. But it doesn't matter. Do your back testing. Test it with 0.2, test it with 0.3, test it with 0.15, test it with 0.4. They will all be profitable. I don't know why I drew that silly shape there, but I was trying to do a tick and my hand didn't want to do it. So it's all profitable. Which one you need to use each day? No idea. Prime example, yesterday, yeah. The trailing stop loss I needed yesterday was 0.3. I used 0.2. Yeah. So the difference yesterday between a 0.2 and a 0.3 trailing stop was a $4.5 grand profit or a $700 loss. Yeah. So the difference between that setting on my trailing stop was a loss or a massive win. Yeah. But another day, what will happen is it will do that for the whole day. Your 0.3 will stop you out with a full loss. My 0.2 would have stopped me out with a small profit. Which is the best one to use? Don't know. Unless you've got a time machine and you can see tomorrow's price action, you don't know which setting to use because you don't know what it's going to do. What I know is in the back testing, it doesn't matter which one I use. They all have a massive equity curve. So you pick one. Yeah, doesn't matter which you use. If you go with a 0.15, a 0.17, a 2 up here for your range, they all are profitable. Which one today you want to use? Don't know. DAX is the FTSE is a good example. Actually, it's not a great example today, but stopped out on the FTSE. So I mean, this one here today, nothing you can do with that, but it's, every setting in the EA is going to give you a slightly different result, but most of the settings in the EA will give you a profitable result long term. You're going to have days and weeks where it just goes parabolic and you just make money. You can't help it. You just make money. If it goes, it goes. You can't not make money in a bullish parabolic or bearish parabolic market. If it's going to go sideways for the entire week, you're going to lose every day. Yeah, but we're not looking at that. We're looking at the long-term profitability of the edge, not what is right to do, what's wrong to do on an individual daily basis. Can't tell that. Morning, electrician. I need an electrician. How did your FTMO account go? I blew it. Yeah, so I blew that up. Unfortunately. Discretion gets a bad rap. All the successful traders I know use it. Yeah, exactly. You can't automate discretion. And discretion is, if you think about it, right? Discretion is used for every person that uses my products. Yeah. So you may think I'm an automated trader, but you are a discretionary trader, because if you come in here and you set this up and you decide to make that 0.17, you've used your discretion to change that input. Yeah. There is no, even with mechanical trading like I do, there is discretion involved in even the way you set it up at the moment. So I've got the NASDAQ set to a 0.3 trailer and that set to a 0.2 trailer. I use my discretion to decide I wanted different trailers on them. I'm a discretionary trader. It's going to be fully automated when it takes the trades, but I've decided to set it up. That's discretion. When it goes and and you see me do it every day in here, you see it fly and it's getting close to my partial profit, and I'm seeing another instrument starting to drop, I move that line down using discretion. You can't not use discretion in trading. If you want something where you can set it up automatically and never look at a chart, it's never going to work, because the market is not static. The market changes. So you've got to be able to adapt to what the markets are doing. But saying that, if you leave an EA on auto, it will still make money. But I think you can make more money by making decisions intraday. Some people don't. But, automating things is very hard. Somebody's asked me to automate a strategy. They sent me a PDF of some, I think it's an IFVG or something. I don't even really know what that is, but it's a fair value gap of some kind, a special one. It's on the 1 minute chart. There is no way to automate anything on the 1 minute chart. It's completely discretionary. When you come down to this time frame, yeah, it's random chop, random price action by algorithmic bank systems. Yeah, there's no way to automate something and back test it reliably on a 1 minute chart. It just doesn't work. But discretion, yeah, will show you good opportunities. So, it's one of those things. If you're trading silly little time frames like 1 minute, plenty of people make money on 1 minute time frames, but the only people that make money on 1 minute time frames are the people that are watching price action in and out, day in, day out, and sitting on their hands for 95% of the day. They will take one or two trades which are going in with high risk. But you can't automate it, because there's no 2 days on a 1 minute chart that will ever be the same. This price action you see here has never happened before. This price action you see here has never happened before. You can't automate this because it's different every day. It will do certain things sometimes, like that. And other times, it will just go straight through it. So at the end of the day, what have you got? An opportunity to wrap risk around a north and a south movement. But when you press the button to buy or sell, it's completely discretionary, especially on 1 minute charts, because they're just chop. You're literally just trading order by order. There's no way to predict it. This is what this, the smart money concept thing with the fair value gaps. You show me 1,000 fair value gaps where it goes and tests it and bounces out. I'll show you 1,000 fair value gaps where it just goes straight through it. What does that mean? The market is binary. Yeah. If you want to buy them when it pulls back into them, do so. Not a problem. I would rather mean revert it and target them, but it doesn't matter. That's what's going to happen, isn't it? You always have a 50-50 shot. If you press the button now and buy, it will either go up or down. What you have is the ability to say, I want to get out when it goes there or there. That's it. This is the only control over the market you have, placing two lines to get in or out, or to get out when it goes in one direction or the other. As long as that one is lower than that one, and you can get it right 50% of the time, that's it. No, it's very, very simple trading. Everybody overcomplicates it with thousands of indicators to try and predict price movement. You cannot predict the future. You have the now and you have the past. Look left. That's where your clues are. Yeah, shorting that is way better than shorting this. Why? Because that's where they're shorting from. You've got bank and institutional price action at your back here. When it gets there, these guys who are short, if they're still short, are going to put more short in the market. So if you sell it here, you've got more chance of it working than if you sell it here. That's an edge. But it could still blow straight through that, or it could hit that, bounce off, and then blow through it. The odds when it gets there are exactly the same. It will either do that or it will do that. There is only two things that can happen. Your choice is which of the buttons you press. That's it. Very simple. So I'm talking in newbie language today because we've got a newbie. I like talking newbie language. It's simple. I can't even say it. Newbie language. I sound like a 3-year-old. Right. Let's have a quick look at where we are. Right. DAX is pushing up. Looks like we're going to try and break out the highs. So we're inside bar on the 15-minute range at the moment. We haven't gone anywhere. We are nearly an hour into the session, and we've got no breakout yet. So whichever way we go today, we will go with the flow. Upside target is within the weekly range. Downside target, all right. We've got this area here, which is where the market is now buying from. So that's easily achievable. 68 retracement. 618. Cable looks like it's hit a point, thinking it will bounce. What time frame are you looking at? So yeah, you're bouncing off the monthly. That's last month's low, which is this previous high here. Yeah, looks good for longs. I mean, it's not particularly strong, but I would be looking at targeting that area there. You've got upside resistance here. So somewhere here above that propulsion gap, you're going to find resistance. So 150 to 175 ADR today is upside resistance. So longs up into there, but it might just sit around and do that for a week. We've got no news today apart from Michigan. So basically later today, if Michigan is used to drive the market today, we would either come and retest that low or we come up and test that propulsion gap. If they don't use it to drive the market today, we're just going to sit around and do nothing. Yeah. Good, good area. So that propulsion gap here is the break of that high. This propulsion gap here is a V-shaped recovery, so less important, but it's a big, strong buy, which they've added to twice. So we know we've got buyers here. We know we've got buyers here. We know we've got sellers up in this area here. But you've got shorter term sellers here. Yeah. But there's no reason to buy the pound at the moment. There's not really any reason to buy the dollar at the moment, except the dollar has had some good news recently. So as you can see, we've had a run of good news for the dollar, but it's not great news for the dollar. It takes one negative news event for this to be back up here. So don't forget, technical analysis is great. This is what everybody tries to teach, technical analysis. Technical analysis works well when the fundamentals don't change. When the fundamentals change, technical analysis has got absolutely nothing to do with anything, because this low here is holding at the moment because there's no reason for it not to, because the last batch of buyers are still, looks like they're still buying. But if Trump comes out and says, I'm going to cancel all trade tariffs, and I've decided to give all of my money and Elon Musk's money to the American people, it will drive the dollar through the roof and we'll be down here because the fundamentals will have shifted. So technically, I think this is the thing you have to, as a trader, you've got to decide, am I a technical trader? Am I a fundamental trader? Am I a momentum trader that just goes with what it's doing? There's a million ways to read the market. None of them are right. None of them are wrong. Right now, it's a technical bounce. This afternoon, if Michigan numbers come out twice as high as we're forecasting, it's going to come down and it's going to break through that support. The fundamentals are realistically what drives the market. The market uses fundamental data to decide on bias for an instrument. Technically, it's great. There's always an argument for both directions with everything. Every instrument you use and every time frame you use, every indicator you use will give you two readings. Yeah, and this is why I do what I do with position trading, is because I don't know which is right. So right now, this week, it's a buy. Yeah. But when it gets up to here, it could well be a sell. But it also hasn't done this propulsion gap yet. So maybe we should be looking at buying down here. Or should we sit on our hands and see what the market does? There's a million ways you can read everything. And if you go down to a different time frame, like the 15-minute chart, it's telling you to sell today. But it's told you to buy yesterday. Yeah. Because all the market does is go up and down. You have to just press the button and think, I'm taking this because of that, and sit in it. And it will either work or it won't work. You decide. I don't know. But have a plan. The most important thing when you're trading is to have a plan. As long as you are getting in, with a plan, and my plan here, if I was position trading, would be to buy it now, and then buy it in this propulsion gap and this propulsion gap, and then buy it again down here. So I get in, I get in, I get in, I get in. There's my average. There's the drop. There's the pullback into resistance. That's my exit. That's my plan. So it doesn't matter what you do, does it? Yeah, if you long it now and you're wrong, you just scale in until you're right. Because it can't be wrong forever. That's what market structure is. If you sell it there and it didn't work out, you sell it there. If it didn't work out, you sell it there. If it didn't work out, you sell it there, and it worked out. You can see my trades actually on the chart. I might as well use my actual trades. Sold it there on the breakout, didn't work. Sold it again, sold it again, sold it again, sold it again, out. Yeah. Didn't get out of all of it, so I had to sell it again and again and again and again. Got out. Then I got out the remainder of it there. But I'm not getting in going, this is a breakout short. I'm going to lose a load of money if it goes the other way. That's the difference, isn't it? So if you get in here long, have a plan. The plan is to scale in until we get down to the monthly support. Then wait for that pullback, which will be either 38.50 or 61.8. Which it will be, no idea. But that's all it does. Pulls back 38. Pulls back 38 in that case. This is probably a bad example, isn't it? But 50% retracement, 38, flag break, 38 retracement, push down, pull back 50%, push up, pull back 50%, pull down, where are we going? 50%, 38%. So 38, 50, 61.8. Look at the propulsion gaps. Same thing. It's all it does. Same thing over and over and over and over again. This is why I say if you learn how the market moves, you don't need a strategy. You need a way to get in and out of it. You need a formula for scaling in and out of market movement. You can't predict anything that pushes up. You can't predict where it's coming back down to. But you know it will come down to one of them because that's all it's done ever in the past. There's no chart you can show me that does not include a 38, 50 or a 61.8 retracement on every single push. Every single push. Or a 100% retracement because it can only do one of two things, go up or go down. And it cannot go in one direction forever. It has to go the other way because otherwise the banks can't make money. So if the banks want to make money, they will always pull it back because they will always take profit on the position they've just created. How much profit they take is dependent on the market participants as you come down. If they suddenly decide they want to add more into their position after taking 50% of their profits, we will go back up. If they decide that they do not want to go up now because the fundamentals have shifted, they will come back down to the origin of that move. And then when they've done that, they will decide how much they want to go back before they continue that short. But none of it is in your control and none of it is predictable. But it is 100% always going to repeat itself. It's the extension of the leg. Yeah. So this one here, you had no pullback on it. Yeah. You didn't get a pullback. So what you actually got was a leg with no pullback, a leg with a 50% retracement, a leg with a 38% retracement, market structure shifted back to the other side. But what are we doing here? Tracing 50% of that leg. The leg is the bit that you will never be able to determine how long it's going to be. This is something that will go on until they want to stop. And you'll have multiple legs within each leg. So market structure is legs within legs. So that is one leg made up of three intermediate legs. And that is the 50% pullback on that leg. And then we had Trump. Now, if Trump hadn't have happened here, yeah, what would we have done? Or one of those two things. But what we had was a shift in fundamentals, which made that the dollar weakened immediately. So we happened to get 100% retracement. But the only reason the 100% retracement happened was because the banks and institutions shifted directional bias here. So if you were long from, or rather short from here, for example, and we'd have got out on that, but you would have scaled in and then got out on that. So if you shorted it from there, you got out on that retracement. Or if you got up there, you would have been out on that retracement as well. Then we pushed up, we pulled back 38, pushed up, pulled back 38. Actually managed to get a 50% retracement on the leg eventually. Pulled back 50%. Now we're pushing down. Where are we going? Don't know, but we will pull back 50% or 38% or 61.8 or 100. Or it will continue down and then do one of those things. But it will always, always do one of those things because this is how banks make money. If banks cannot make money, the world stops working because this is how the world works. Economics is banks making money. So all the time the banks are making money, you'll have market structure. All the time you've got market structure, you have an opportunity to mean revert into positions. Yeah. For the size of that, squeeze, flag break, Trump. Nothing you can do about that. At that point, the market was ready to pull back. But Trump came in and said, you guys in Europe, we're not going to help you with Ukraine anymore. We're not going to give you any more money. So you're either going to all die or you're going to come up with some cash. So the Europeans had to do a massive bond auction. Yeah. Nothing you can do about that. If you were short here, you lost. If you didn't get out on that, there's nothing you can do. That is a loss. But that is not in your control either. That's a kind of a black swan event, isn't it? But look what happened. Always will retrace 50% of the move. Always, at some point. Your job is to survive that. That one, probably not survivable. Yeah, so you would have taken a big loss on it. But, you know, these events with Trump are not normal. Normal market structure, yeah, is that. A-shaped recovery. Head and shoulders that failed. Yeah. Push, pull. Push, pull. Push, pull. Every time. Every time. You just have to survive each of these pushes. Yeah. 50%. 50%. 61.8. 50%. 50%. Probably 61.8. Yeah. Every move. Every time. Every time. There is no time where it isn't. Since I've been following you, I've noticed that although longer term, the indices always go higher, I've found the retracements far more reliable than forex pairs, especially the FTSE. Going to stop out on the DAX as well. It's going to be another one of those days today. There's just no momentum in the market, is there? I don't know. They don't always go higher. They will always try and go higher. But indices basically are manufactured, obviously, to go up. You know, that's their job. So the whole purpose of a stock index is to monitor the top stocks. The top stocks will always increase in revenue, and the ones that don't drop out the bottom and get replaced with ones that are. So they will always go up. But so, you know, this is where everybody comes in with this whole long bias thing. And yeah, there is an argument for going long only. So if you buy every dip, you will be right. Yeah, I mean, there's no dips you will buy that do not go long. Yeah. You know, it is textbook, clockwork. It's just what it does. But occasionally when you go into a bear market, that's when it's going to catch you out. And if you buy every dip in a bear market, you're stuffed. Because you just won't. You will be in drawdown. This is where everybody's in drawdown for a long time. Yeah. Look at the last bear market we had and how long it went on for. A year. Bear markets tend to last a year when we go into them. This one has only lasted sort of 3 months, but this isn't a bear market. It's a Trump, isn't it? It's a totally different thing. But it's funny, isn't it? When you measure it. Just what happens all the time. It's maths. All markets are maths. It's a mathematical equation. So banks and institutions have incredibly complex algorithms calculated by very intelligent people, quants, to basically use mathematical statistics to extract money from market movement. So market patterns are created by banks. Banks create those patterns because they make money. So therefore, they become a self-fulfilling prophecy because the banks know that they're going to make money doing what they do. So therefore, it happens because all the banks do the same thing. They drive money into a portfolio and then they extract money from the portfolio. They drive money in, they extract it. They drive money in, they extract it. So it's like opening up a shop, putting stock into it, selling some stock, having to buy more stock, selling some stock, having to buy more stock, selling some stock. It's the same thing. Yeah, it's how business works. It's statistics, it's maths. You don't buy a load of stock at $100 and then sell it at $90. You sell it at $130. When you run out of stock, you have to buy more stock. All markets work in the same way. There is an amount you can do before exhaustion hits. Therefore, you have to take profit because you cannot do what you want to do. If you want to run in that direction for 10 years and there's a brick wall in the way, you can't. You have to stop and come back and wait for someone to knock the brick wall down before you can do your next little run. Yeah. Every market has a buyer and a seller. Every order has a buyer and a seller. If you continuously buy and everybody is selling the stuff that you want to buy, eventually you will have bought everything and there will be no more people selling. So when that happens, what do? You can't buy anymore. So what do you have to do? You've bought everything from them, so you have to become a seller and sell to the next load of people that are buying. There's no more sells. Okay, well, I'll sell my stuff. There's a load of people buying. How a market works. It's how all markets work. Structure. But stock indices are different in the fact that the price of the thing being sold is continuously increasing as market caps go up, as valuations on companies go up, as companies get bigger, their products are sold to more people, become more profitable, and it continuously goes up. And this is why stock markets are always going to go up. Yeah, this thing won't stop doing this. It will do it forever. This is going back to 2011. It's just going to keep going. Because as long as businesses make money, stuff goes up. Isn't it? But the pullbacks are, I think, a lot more difficult to predict in the stock markets because stock markets are fear and greed driven. And obviously, we are human beings and fear and greed is something that drives our cycles of buying and selling as well, which is why we have the fear and greed index. You know, we have this fear and greed index in here, which tells you how aggressive all this is an indicator that tells you how aggressive the market's being. Yeah, we are aggressive at the moment. In an extreme greed, we go up, and in extreme fear, we go down. The problem with this indicator is it tells you what's been happening. It doesn't help me, does it? Because it doesn't tell me what's going to happen. But as long as we are greedy and nothing goes wrong, we will stay greedy. You know, so this is where people decide, shall we buy stocks, shall we sell stocks? When you start getting over to here, you do want to just be a buyer. There's an argument for when you hit the neutral level, you stop trading the stock market and you wait until you're down here and you see this thing start to tick up. That's the dip you buy. Because when you get down here, we are pulling back. When you get up to here, we are pushing. But like all indicators, this tells you historical information. It's no good for seeing the future. What's going to happen in Michigan this afternoon? What's that number going to be? Unless you know what that number is going to be, you do not know whether to buy or sell the dollar this afternoon. Stopped out on the DAX. Choppy day. So the only hope I've got today is that we collapse. We've got gap fill on the DAX as well. Right, that's all I've got for you this morning. Did you remove the COTS from your website? Yeah, years ago. Well, not years ago, a long time ago. I haven't had any financial data on my site for ages. That is on this new website. There's a lot of that. There's no COT there, though. Commitment of Traders report at the moment is useless. The Commitment of Trader report is very useful when the market is normal. The market is not normal at the moment. So the trouble with COT is you're always 2 weeks behind So the data you receive is last week's data. Last week's data is an amalgamation of the full week. So you're always roughly a week and a half behind on COT data. For those who don't know, COT is commitment of traders. It's the market positioning in the futures market. So it tells you basically, it basically is a report of what direction the banks are trading in, which is why it's used a lot. But it's mainly used by banks. So if you look at the non-commercial orders in the commitment of traders report, that tells you what the speculative traders are doing. The speculative traders tend to be in line with bank movement. So if 80% of commitment of traders are long on the dollar, it means that they've been buying the dollar for the last few weeks. The dollar will have gone up. You'll see that on your chart. So it doesn't help you, does it? It's an oscillator. It's the same as this. Yeah. So if you think of the, let's call this the COT indicator. Yeah. If it's up there, it means the market's been going up. It will tell you that they've been buying the dollar or whatever it is, oil in this case. If the commitment of traders report on oil is sitting at 70, it means that 70% of the market is long oil. It will have gone up because we're looking at 2 weeks worth of data in the past. So it doesn't help you. What it does help you with is they've been longing oil for weeks. What do you think they're going to do at some point? Take profit on that move. So COT you can use as a contrarian indicator in the same way as you can use retail sentiment as a contrarian indicator. At the moment, the pound Swiss 89% of the market is long on the pound Swiss. So I am selling it because they are wrong 90% of the time, aren't they? Retail money or broker related money is usually wrong. So I'm shorting this because they're longing it. Yeah. Same with COT. But look, it's a short signal anyway. So if you see the market longing something for 5, 6, 7 days, yeah, you want to go the other way because it's done that. That's the next thing it's likely to do because that's all it ever does, isn't it? If you see this thing coming down for a week and a half, buy it. This is what this is all about, the AWR. If on Thursday we've moved 150% of the normal weekly range, yeah, it's highly unlikely we're going to go much further, is it? Because on average, we do 89 pips in a week. We've done 133 pips this week. That's a lot further than normal, isn't it? What normally happens after that? A pullback. So this is what this indicator is all about. As soon as this lights up red, you look at it and you go the other way because it's done that. What we can't do as traders is predict the future. What we can look at is what's happened in the past over and over and over and over again. So if you get in today and you decide on either a long or a short, you have a 50% probability of that long or short working out. If it's been going up for 7 days solid, I have a much better opportunity and odds of it coming back down again because historically, when it's done that for 7 days in a row, most of the time, at some point in the next few days, it's going to come down. Here, if I buy it today, where it's gone nowhere, it could push against me for 7 days, couldn't it? Which means I'm going to go into a squeeze and I will be on the squeeze on day one, which is why we look at movement that's already happened and use that to get in on. Yeah, it's already pushed all the way down there, so buy it. It's already pushed all the way up there, so sell it because it's done the opposite. So all it does, isn't it? It goes up, goes down, goes up, goes down, goes down, goes up, goes up, goes down. Whatever it does the opposite thing at some point soon. This is all this is telling you is it's gone down for ages, so it's likely to go up. When it's going to go up, we don't know. How far it's going to go up, we don't know. But we do want to be in the direction it's going to go. If you see something going sideways for 6 weeks, there's a 50-50 probability. If you see something that's gone that way for 6 weeks, there's a much higher probability of the opposite thing happening. This has been going down for sideways, really. 2 weeks. Look at it on a weekly chart. Been going down for 2 weeks after having a big down week and 2 indecision weeks. Yeah. So it's a big, strong push to the downside. Yeah. Went down for 3 weeks there. Went down for 3 weeks there. Down for 2 weeks there. Down for 2 weeks there. Down for 2 weeks there. Pulled back 50%. Pulled back 100%. Pulled back 61.8, and then it carried off. But you see, you get the odd one where you're going to fly for 6 or 7 weeks on the chart. Nothing you can do about that. But eventually, it will pull back by, depending where you measure from, depending where you think the move started, but 38 to 50%. Pushed up, pulled back pretty much all of it. Pulled down, pushed back pretty much all of it. Pushed down, came back 50%. Sat around for weeks doing absolutely nothing. Had a little rally, collapsed, pulled back 50%, pushed down. Where's it going next? All it's going to do over and over again. Constantly. What we can't do is time it. Anyway, I'll shut up now. Right, so back this afternoon. I'm going to have to try and get some money back this afternoon again. 2 choppy days back to back. So Michigan this afternoon obviously is our opportunity for movement. So we'll see where we are this afternoon, but hopefully, I mean, Friday afternoons are always a bit hit and miss. I've been doing some interesting analysis with this new website on my accounts, and I'm definitely not good on Friday afternoons. I'm not good. It's the market's not good on Friday afternoons, the vast majority of the time. So Friday afternoons are always a bit dodgy, but if I can get back to a break even today, I'll be happy with that. So I only need 1 break basically. So 1 trade with a 2R back to break even. So if we can get a 3R, or we can get 2 breaks with 2R, that's up for the day, isn't it? So that's the goal this afternoon. So we'll see where we go then. I'll be back at 2:30. If there's anything you need, I'll be in Discord or in Telegram. And I'll be continuing to work on this website and hopefully get a member stream done next week for everybody to have a look at what they're doing on that. Yeah, and doing some very interesting AI related stuff, which is good. So I'll be back this afternoon. Anything you need, let me know. Other than that, I will see you next time. Have a good day.